Hello everyone, very good evening to all. Welcome you all in the session of Oliveboard. I hope you all are fine and doing well. Please confirm my audibility and visibility so that we can start our today's session. I hope everything is fine, everything is perfect. So yes, in yesterday's session, what we completed unit number 18, the working capital finance. We did some of its important concepts yesterday. So today we have to start a very new unit, that is unit number 19 of module C, credit management, and the name of the unit is what? Term loans. So I hope you all have heard this word in your lifetime, the term loans. Before that, this is our selection CIB selection batch for June July 2025 examination. So it contains all in one course, that is you will be provided 250 plus sessions of all the paper, all the four paper plus elective paper. And early morning, late evening sessions will be there. The clarity, concept clarity, we will provide you advanced preparation because nowadays the level of the questions are going very high. So according to the level of the question, according to the paper analysis, we are giving you that kind of preparation. So every week you will be having your live and doubt revision classes where you can sort out your doubts, you can ask your queries from the experts of our olive board. And what additional benefits you will get that again, you can download all the PDFs. You have access of 24/7 of all the PDFs. Although you have not watched the live classes, still you can download the PDF. You can watch their recordings as well. We will provide you 50 case study plus numerical based test and 20 test for elective paper. So we have five papers in elect. So we will provide you five, that is four tests in each elective paper. Now, and this medium will be in English and Hindi. So I am covering the English one. My medium is English for ABM and ABFM. And for elective paper, my medium is a mixture of both as Hindi as well as English. So please do enroll now and get the benefit of all these things. Now, what are term loans? Okay, the basic definition of term loans are what? Term loans are long-term finance. See, for current capital, okay, for current assets, what type of finance we take? We take working capital finance. But for your fixed assets, for your non-current asset, what type of finance you will take? That is term loans. You will take the help of term loans, that is for fixed assets and as well as non-current current assets. But for current assets, you will take what? You will take which kind of finance? You will take working capital finance. So we have seen working capital that it is a type of capital, okay, which we require for our day-to-day operations of a business. Long-term finance means what? That is for a very long-term period. You will obtain long-term loans from banks or any other financial institution that you don't need to repay them for a short period of time, like less than 1 year. So it may be of 5 years, these long-term finance, it may be of 10 years, it may be of 15 years, for 20 years, or for more than 20 years as well. So term loan is what? It is a type of loan where a fixed amount is borrowed from a financial institution for a specified period ranging from 1 to 10 years. So below 1 year, we take short-term finance, and as soon as it is above the 1 year, it comes under long-term finance. So what happens basically, you know everything. If a business owner or any investor wants any kind of the money, so they will go bank, they will borrow the money. The bank will provide them the money. They will lend the money at a predetermined rate, the interest rate, and they have to pay the repay amount and interest amount after the repayment date comes. So this is what the term loans is, and this is what the criteria to fulfill the term loans to the bank. So term loans are commonly granted to small businesses that need cash to purchase equipment. So term loans are basically granted for the retail business, For example, if you need to purchase any kind of equipment, if you need to purchase any machinery, a new building for your production processes, raw material for your finished goods. So such type of loans they are the bank granting. Now, important points about term loans. Bank provide long-term loans normally for what? For acquiring fixed assets like land, building, plant, machinery. So these loans are basically provided only for the long-term period. And if the current assets, if like working capital cycle, we have seen yesterday working capital cycle. Suppose if this working capital operating cycle is the cycle is a very long term period, like for 5 years, for 6 years, then still the bank can grant them term loans because the term period is very long. Working capital cycle is a very long period. So for long term period, the bank can grant them term loan. So here it is written, very important, in exceptional cases, banks provide them term loans for current assets also. When banks see that the working capital cycle, okay, this cycle takes almost 4 to 5 years to complete one round, then for such type of category, the bank provide them term loans for current assets. This is called working capital term loan. And what is called? It is called working capital term loan. WCTL. Term loans, they are payable at the agreed repayment schedule, which is stipulated in the terms of the sanction. So everything has to be documented. The bank has to give them at the specified date, stipulated time. Everything should be mentioned over there. And as soon as the term loan is expected to be repaid amounts for the future cash flows, the borrower has to repay that loan to the bank. So there is no uniform repayment schedule for all term loans. So every business to business, it depends. Okay, it changes from business to business. So there is no such kind of uniform repayment. For some business, the schedule is that they will pay after the grace period. They will pay as soon when the repayment date comes. So it depends from business to business. Deferred payment guarantees. These are known as DPGs. So what is DPG? Again, the simple. Okay, this is what you can say. This is discounting a type of. Okay, like what happens when the purchaser of a fixed asset does not pay to the supplier immediately but pays according to an agreed repayment schedule and the bank guarantees this repayment. The guarantee is called DPG. Suppose yesterday only I have taught. Suppose this is the vendor. This vendor sells his good to this particular person. This is buyer. Now, this buyer says that after 1 year, after 2 years, okay, I will repay the amount. Please sell me these goods on credit. Now, this vendor will sell the goods on credit to this particular buyer. But in between, after 2 years, in between the 2 years, suppose this vendor needs money in a very emergency. So what this vendor do? This vendor will go to the bank. The vendor will show the document and he or she will discount the bill. Okay. So what is happening? He or she will discount the bill and vendor will pay him the money back. Like let's say 10 lakh rupees. Okay. The amount was 10 lakh rupees. On behalf of this 10 lakh, the bank will pay 9.5 lakh. Rest 50,000 will be the profit of the bank. Okay. Now, this is the scenario when the normal discounting does, when the bill discounting is done. Now, deferred payment guarantee is what? Payment guarantee, that one person is giving the guarantee of to another person. Okay. If if this person will not pay the money to you, then certainly I will pay the money to you. This is the guarantee given by one person to another person. And on behalf of that, the bank will give the amount. The bank will sanction the amount. Okay. See, suppose this vendor is not giving the supplier is not giving the money. Let's take an example. Okay. Supplier is on credit. I have purchased the good. Now the supplier is not agreeing on this. So what happens? The buyer will give the guarantee of the supplier to the bank. Bank will give the guarantee to the supplier that, okay, if this person will not refund you the money, I will refund you the money. That is what deferred payment guarantee. Clear? So bank will guarantee the repayment And this guarantee is called what? DPG, according to an agreed repayment schedule. Am I clear with this? Okay. Hmm. Next, project appraisal can be broadly taken into following steps. See, what happens that the risk of the banks, okay, increases when lending finances more increases for the infrastructure project. We know that for infrastructure project, we need a lot of finance. We need a finance in crores and crores. Now, so what happens? The risk of the bank also increases. For this, risk of the bank also increases. The bank also use different methods to mitigate the risk. Here, so in this case, what happens when bank use different techniques, different methods to mitigate the risk? So there one comes the loan appraisal, and one comes what? The project appraisal. Now, what is this project appraisal? See, project appraisal is basically what it evaluates a project's potential, including its all the risk and return. It also involves the reviewing of the project. Okay, reviewing the project's work plan, their cost, estimates, and finances. It also considers the project's organizational and management aspect, consulting with stakeholders. Everything should be related to what it is. It should be related to the project only. So basically, this project appraisals helps in determining that if a project is desirable and offers good value for money or not. If it is desirable, then we can go for it. Okay, person can go for it, owner can go for it. If not, then they can go for another asset. So different steps has to be taken in this project appraisal. Appraisal of managerial aspect. This one is taken. Then technical appraisal, economic appraisal. So we have different appraisal, environmental appraisal. Okay, so managerial aspect is what? That everything should be related to the top level management. Technical appraisal, that we should how to use the technology, techno friendly things should be there. Economic environmental aspect is what in whichever project I'm investing, that it should not impact the environment, it should not create any kind of hardships to the environment. The market appraisal related to market fluctuations, demand, supply. Financial commercial related to trade and purpose. And break even analysis is what? Like when a situation comes for a business, when there is no profit, no loss. Such type of situation is what? The break-even appraisal situation. For example, let's take a break-even is what? See, company has uh, company has incurred the cost of, let's say, 10,000 rupees. Okay, in this cost, the fixed cost also is there, and the variable cost is also there. So we have total cost. We have two types of total cost. One is fixed, one is variable. Fixed cost means that is the level. Fixed cost means everything is fixed. The cost does not change as the level of the output changes. That is the fixed cost. And variable cost is what? It means that the cost changes when the level of the output changes. That is variable cost. So fixed and variable cost break even point means what? That is when a company has attained a position, when a company has attained a position where the cost is equal to what? The revenue they have earned. It means there comes a situation when the company is no profit, no loss. See, company has company has done the sales of what? Company has done a sales of, let's take an example, 5,000. Clear? Now, in sales, the company has deducted its variable cost. Variable cost means you can say the electricity, okay, the machines, the salary of wages. the salary of labor, wages. All these are what? These are your variable costs. And what is fixed cost? Like rent. You have installed a machine on the factory, and the rent of the factory is what? The fixed cost. Clear? The electricity is what? It comes under fixed cost. So you will use whether the production is happening or not, but you have to give this money. You have to pay this money. So all this money is what? The fixed money. You have installed your machinery, that comes under fixed cost. You are paying your rent every month, that is the fixed. You have that comes under fixed cost. Now, if you will deduct the variable cost, let's take an example 3,000. So this 2000 is what? Contribution. So this, you cannot think that this 2000 is what the profit of your company. No, this is just the contribution. And in this contribution, you will deduct your fixed cost, you will deduct your interest, you will deduct your tax. Then whatever the value comes, that value is what? Your profit, your ultimate profit. After doing this, all these things, a company comes in a position when they have expended 10,000, and in return, after doing all the deducting variable cost to fixed cost, they come at a position that their cost has been recovered. So once their cost has been recovered, so that position comes a break even point. After that, whatever comes, that will be the profit of the company. Clear? Any doubt, anyone? Okay. So once the company has recovered its cost, after that, what the company will make the profit, what the company will get in return, the revenue, that revenue will be termed as what? The profit of the company. So this is called break even point, break even situation, where a company's revenue is equal to cost, that is no profit, no cost. Like for 1 year, company made a profit of 2000. Again, company made a profit of 3000. Again, company made a profit of 4000. Okay, then company made a profit of 1000. So now the 10,000 has been recovered in 4 years. After that, in the fifth year, 1 month, second month, whatever the company will make, the revenue, that profit is, that profit will be calculated as the profit. Otherwise, the all this profit went to recover this cost. Now the company, after 4 years, the company will gain break even point. So what were the technical appraisal? Okay, technical feasibility of the project. It includes the products to be manufactured, the technicalities, production process, uh, the production is going through different stages, through different activities. That is also included. The infrastructure, pollution control, availability of raw material. So these are all included under technical appraisal. Economic appraisal, the return on investment and break even analysis. So return on investment, if you are investing on any project, so what return you are getting back after applying discounting, after using different techniques, different models of capital budgeting, what return you are getting on investment, that is return on investment. For this, we have different methods. NPV stands for net present value. This tells you the present value of future cash flows. Okay. And there is one compounding also, that tells you the future value. Okay. Now, payback period, cost benefit ratio, accounting rate of return. It is also known as ARR, and IRR is what? Internal rate of return. All these are the techniques of capital budgeting. So we have uh, old techniques also, we have new techniques also. Now, break even analysis, this I have made you clear. A project with high break even point is considered more risky compared to the one with a lower break even point. So as you have seen in this over here, that if the break even point is very high, it means you have a risky business, and if it is lower, then it means that there is low risk. Any doubt to anyone? Tell me. Here? No. Appraisal and financing of infrastructure projects. After appraisal, what if we know that there are the bank pays more risk on financing the infrastructure projects. Okay, so what are the different types of financing by the bank? In what ways the bank can give the finance? First is take out financing. Second is inter-institutional guarantees, and the third one is financing promoters' equity. Now, what is the first type of finance? Take out finance means long-term financing that the lender assures to provide on a specific date or when specific project completion criteria met. See, what happens basically in this, take like when you have thought that when banks provide money offer, certain amount of work has to be done. Means, for example, like this, the person has the person went to the bank and he asked for like let's take an example 1 crore rupees for making a flat. Okay, flat of let's say 20 floor flats. Now, what taking take out financing, what the bank will say, okay, you want money 1 crore, I don't trust you more. So if you have done a few work, like if you have when your third or fourth floor gets completed, okay, after that come to me and then ask the money and then I will allot you the money. That is what take out financing means, long-term financing that the lenders assures to provide on a specific date or when specific project completion criterion met. So lender is what in this case the bank. So bank will assure that I will provide you, I will give you the funds, I will finance you, but when your little bit quantity of work has been done by you, when you have completed your fifth floor, when it's the time for the construction of sixth floor, then I will lend you the money so that I may also know. Suppose I have given you the crore. Now after 1 year, 2 years, the work is has not been started yet. So how would I know that you will refund my money back? So that is why, okay, start the work. After that, if the work is in progress, then I will give you the money. Or if the certain criteria are met. Tell me, any doubt to anyone in this particular point A? It is very important. Okay. So when banks provide money after certain amount of work has done, like for for multiplex, if I want to make a multiplex, okay, then if I can go to the bank and I ask for again 50 lakh rupees, 1 crore rupees. So what the bank will say, the lender will say, okay, first what you have to complete till third or fourth floor, then for the rest of the floor, I will give you the money. Now, next is inter-institutional guarantees. So what this basically tells that this basically tells that one when one bank gives guarantee for another bank, like person came to PNB, okay, now, this PNB bank, he asked for 50 lakh rupees. The PNB bank says that, okay, I'm giving you the, uh, go and ask the money from Union Bank of India. Yes. PNB says to this borrower that I'm giving you the guarantee of this bank that this bank will give you the money 50 lakh rupees. Now, so this is inter-institutional means from one institution to another, one institution to another. So one institution is giving the guarantee to another institution that please give the money to this particular borrower. But what the criteria has to fulfill? So banks are permitted to issue guarantees. So this PNB is giving guarantee of Union Bank of India to this particular borrower. favoring our offer lending institution in respect of infrastructure project. And this the lending or the guarantee has been made only on infrastructure project. Remember. What happens? Like UBI gives guarantee that okay, PNB gives guarantee that Union Bank of India will give money. Now, Union Bank of India will only give money when Punjab National Bank has given 5% of the amount of the foresaid amount to this particular borrower, as said by whom? As said by the RBI. Now, see, this much you have understood. Banks are permitted to issue guarantees favoring other lending institution. Now, in this case, PNB has given the guarantee, okay, to Union Bank of India to lend the 50 lakh rupees to this borrower. Provided the bank issuing the guarantee takes the funded share in the project. Means this particular bank can only give the guarantee when this bank has given 5% of the project cost under normal credit appraisal, monitoring and follow up of the project. So according to RBI will say that okay, you can allot this particular bank to give the money only when you have given 5% of the cost. Like 50 lakh rupees this person has demanded. So 50 lakh into 5%. Now, so what you have to give? You have to give 2500. After that, this the rest of the amount this bank will give. So this is what the guarantee. Inter institutional guarantee. One bank gives guarantee for another bank to the borrower. That is inter institutional guarantee. Before giving the guarantee, the previous bank has to give 5% of the project cost, and after that, the rest of the amount the other institutional bank will pay to this person. Done. Now, financing promoters' equity. So, what is promoters' equity? See, every company has their promoters, every company has their shareholders. Now, in such case, banks are not allowed to finance promoters' equity. Basically, the money funds should be brought by the promoters for contributing an infrastructure project. So bank will what say that you are the promoter, you are the owner of the company, you are the shareholders of the company. You have to bring funds for your infrastructure project, but there are certain criteria, certain conditions that has to be fulfilled. Then only I can give you the money. So banks are advised that the promoters' contribution towards the equity capital of the company should come from their own sources. You can use either your reserves, you can use either your internal accruals, okay, you can use your profits, your retained earnings. So you have to bring your own resources. Bank will not going to finance you in such cases. So banks are not allowed to finance promoters' equity. So basically, they have to bring the money from their own sources. And the bank should not normally grant advances to take up shares of other companies. So banks are not allowed to take the advances of the to to take advances to take the shares of different companies. So they only have to bring their own funds finance. Now, so these three are very important. Takeout financing. What happens in this takeout financing when bank provides money after certain amount of work has done? For the rest of the things, the bank will provide the money. Inter-institutional guarantees, it means what? When one banks give guarantee for another bank to provide the money only when the first bank has given the 5% of the project cost. And in financing promoters' equity, the banks are not allowed to do this, not allowed to grant advances to take the shares of other companies. They only have to bring their own funds, their own fine. Done? I hope now everything is clear to you. Okay, then let's meet tomorrow with our next topic. So today we have completed what? Term loans. I hope you have enjoyed the session. Everything is clear to you. If any confusion comes to your mind, then please do ask. Please Yep. Chal. Let's meet tomorrow. I hope everything is clear to you. So all so term loans are very important concept. The deferred payment guarantees, that is just the discounting of bill. So we have seen the project appraisal, why it is necessary, why it is done. Then break even point, how a company gets at the position break even point, no revenue, and when the revenue is equal to its cost. I hope everything is done sorted. So let's meet tomorrow. Till then, take care, everyone. Goodbye. Keep studying. Keep watching.